Hey, what's up, legends? Welcome back to the channel where we break down business, money, and investing without the Wall Street fluff. Today, we're talking about how to value lower market companies like a pro. We're talking about real businesses, plumbers, manufacturers, software startups, agencies, with revenues under $50 million. You know, the stuff that doesn't make CNBC but could make you a millionaire. Whether you're buying, selling, investing, or just plain curious, this video will give you the full playbook. Let's get into it. Now, y'all, this first method is about as straightforward as it gets. It's called the earnings multiplier, and it's all about figuring out what a business is worth based on how much money it's bringing in. Think of it like this. You've got your grandma's secret recipe for the best pecan pie in the South. Now, that recipe doesn't have a price tag on it, but you know it's valuable because everyone's always begging for a slice. A business's earnings are kind of like that secret recipe. They tell you how much that business is cooking up in terms of profit. So let's say you're looking at a landscaping business that's pulling in $200,000 a year in profit. Now, depending on the industry, you might multiply those earnings by, say, 3. That would give you a valuation of $600,000. But hold your horses. It's not always that simple. Just like every pecan pie recipe is a little different. Every industry has its own special ingredient, its own multiplier. A fancy restaurant might have a multiplier of 5, while a car wash might be closer to 2. Why the difference? Well, some businesses are just naturally stickier than others. People are more likely to keep coming back for more year after year. That landscaping business we talked about? Well, folks need their lawns mowed every spring, right? That makes it a pretty safe bet. But a trendy food truck? That's a little riskier. Tastes change, y'all. So before you go multiplying those earnings, do your homework. Look at similar businesses in the same industry and see what their multipliers are. That'll give you a much better idea of what that business is really worth. Now, this next method is for those of you who love a good spreadsheet. It's called discounted cash flow, or DCF for short. Don't let the fancy name scare you off. It's not as complicated as it sounds. Imagine you've got a crystal ball that can predict the future. You look into that crystal ball and see that your business is going to make a whole lot of money over the next 5 years. DCF is kind of like that crystal ball. It helps you figure out what those future earnings are worth today. Because y'all, $1 today is worth more than $1 tomorrow, right? Think about it. If someone offered you $100 today or $100 a year from now, which would you choose? Of course, you'd take the money today. You could invest it, buy yourself something nice, or just hold on to it. The point is, it's worth more to you right now. That's what DCF takes into account. It discounts those future earnings back to their present value, giving you a more accurate picture of what that business is really worth. Now, this method works best for businesses that have a pretty good track record and are expected to keep on trucking along. Think about a company that makes toilet paper. People are always going to need that, right? But for businesses that are just starting out or are in a really unpredictable industry, like fashion or tech, DCF might not be the best fit. It's like trying to predict the weather in Louisiana. It could be sunny one minute and raining cats and dogs the next. So if you're dealing with a business that's got a solid history and a bright future, DCF can be your best friend. But if it's a wild card, you might want to try a different method. Now let's talk about book value and adjusted book value. This method is all about looking at a business's assets and liabilities, basically what it owns and what it owes. Think of it like this. You're at a yard sale and you see a beautiful antique dresser for sale. The price tag says $50, but you know that dresser is worth way more than that. Why? Because you're smart, you've done your research, and you know that antique furniture is in high demand. Book value is kind of like that price tag. It tells you what the business's assets are worth on paper, but it doesn't always tell the whole story. That's where adjusted book value comes in. It's like taking a closer look at that dresser and realizing it's not just old, it's an original. Suddenly, that $50 price tag seems like a steal. Adjusted book value takes into account the real-world value of a business's assets. Maybe that old delivery truck is still in great shape, or maybe that prime real estate the business owns has skyrocketed in value. This method is especially helpful when you're looking at businesses with a lot of tangible assets, things you can actually touch and put a price on. Think about a manufacturing company with a warehouse full of equipment or a construction company with a fleet of bulldozers. But for businesses that are more about ideas and intellectual property, like a software company or a design firm, book value might not be the most accurate measure. It's like trying to value a painting based on the cost of the canvas and paint. It doesn't quite capture the true worth of the art. So if you're dealing with a business that's got a lot of physical assets, book value and adjusted book value can be your secret weapon. But if it's more about brains than brawn, you might want to consider other methods. Now, this next method is all about being nosy, in a good way, of course. It's called market comparables, and it's like checking out the neighbors' houses before you put your own on the market. You wouldn't want to sell your house for way less than it's worth, would you? Of course not. That's why you look at what similar houses in your area have sold for recently. It gives you a benchmark, a starting point for negotiations. Market comparables for businesses work the same way. You find other businesses in the same industry, similar size, and maybe even in the same geographic area that have recently been bought or sold. Then you compare apples to apples. What were their revenues, their profits, their growth rates? This gives you a range of valuations that can help you determine what your target business might be worth. Think of it like this. You're opening a cupcake shop, and you want to know how much to charge for your delicious creations. So you do some recon. You visit other cupcake shops in town, check out their menus, and see what kind of foot traffic they have. If those other shops are selling their cupcakes for $4 a pop, you know you can't get away with charging $10, right? Unless your cupcakes are made with gold dust, people are going to go for the cheaper option. Market comparables help you find that sweet spot, a valuation that's in line with what other buyers are willing to pay for similar businesses. Now, this method works best when you have access to good data. And luckily, there are tons of resources out there, business brokers, online databases, industry reports, that can give you the inside scoop. So if you're ready to put on your detective hat and do some digging, market comparables can be an incredibly valuable tool in your valuation arsenal. Now, this final method is for those businesses that might not have figured out the whole profit thing just yet, but they sure know how to bring in the dough, literally. It's called revenue multiple, and it's all about valuing a business based on its top-line revenue. Think about a hot new tech startup. They're growing like crazy, adding users left and right, but they're still in the red when it comes to profit. Does that mean they're not worth anything? Absolutely not. Revenue multiple recognizes that sometimes revenue is a better indicator of a business's potential than profit, especially in the early stages. It's like valuing a promising racehorse before it's even won a race. You know it has the potential to be a champion, even if it hasn't crossed the finish line first just yet. So, how does it work? Well, you take the business's revenue and multiply it by, you guessed it, a multiple. The specific multiple will depend on the industry, the business's growth rate, and a whole bunch of other factors. Let's say you're looking at a subscription box company that's bringing in $1 million in annual revenue. Now, subscription boxes are hot right now, so they might command a revenue multiple of, say, 5. That would give you a valuation of $5 million. But remember, just like with all the other methods, it's important to do your research and compare apples to apples. A subscription box company with a high churn rate, meaning people are canceling their subscriptions left and right, is going to be worth a lot less than one with a loyal customer base. Revenue multiple is a great tool for valuing businesses that are growing rapidly, even if they're not yet profitable. It's also helpful for businesses in industries where revenue is a more important metric than profit, like e-commerce or advertising. So if you're dealing with a business that's all about that top-line growth, revenue multiple might be your go-to valuation method. Valuing lower market companies is both art and science. You've got the math, sure, but it's your insight into risk, opportunity, and operations that seals the deal. So whether you're buying your first business, making an offer, or just prepping for Shark Tank, know your numbers and apply the right methods. If you learned something today, do me a favor. Hit that subscribe button, smash the like, and drop a comment with your valuation questions. I read them all. Thanks for watching, and until next time, keep investing wisely.